Oh, here we go. Starting to funnel in here.
Yes, we are.
Good afternoon, everyone. Thank you guys for joining. We'll let everybody kind of get situated and on here. So Corey, we'll do a little. I got to ask you a question, and I didn't preface this. This is again, thank you guys for tuning in. But your Rams won the Super Bowl.
My Rams. Rams did win the Super Bowl.
So I'm curious, you growing up a hardcore St. Louis Rams fan, right? What was that? The Marshall Faulk days? Was he a Ram?
He was. Him, Kurt Warner.
Kurt Warner? Was
Torrey
that
Holt,
the
Isaac
greatest
Bruce,
show on turf?
You got it.
So I'm curious because I've grown up my whole life a Chiefs fan, and I don't know what I would do if they moved cities. So are you really not a Rams fan anymore?
No, and I would guess that if the Chiefs left Kansas City, you probably wouldn't be a Chiefs fan anymore either. I could be wrong.
I don't know. It depends on where they go.
And the circumstances of their departure.
Okay.
I think that's probably why a lot of people feel the way they do about the Rams, at least in St. Louis.
So are the Rams now your least favorite team?
No, not really. I mean, I've got to the point with football where I like to cheer for the Chiefs, but beyond that, I don't get too caught up in it.
Okay. Favorite Super Bowl commercial?
I didn't watch.
Oh, wow. I just can't understand that.
I didn't watch any of it. No game, no commercials, no halftime, nothing.
What were you doing?
I was actually celebrating Valentine's Day with my wife a day early. We did that on Sunday night.
Did you go to dinner or somewhere? Or?
No, we cooked dinner at home.
What'd you cook?
Steaks, twice baked potatoes, vegetables, salad. It was good. But that's what we did on Sunday night.
Now, do you like a wedge salad or a Caesar salad when you're making it at home?
I like both, but I like a wedge salad more.
Is that what you guys made, a wedge salad?
Wasn't a Caesar salad either. It was just like a garden salad.
Garden salad.
What did you do Sunday night, Jake? I'm going to ask you some questions.
We're
watching the Super Bowl.
Like every other American.
Yeah, I know. It's hard for me to.
Thank you, Jay. Now Jay's hungry.
Yeah. Jay, if you want to come over for a garden salad, I've got you covered.
All right, good. Enough about your personal life here, Corey. So, okay. Well, thank you all for joining. And thank you, Jay, for your comments. Unfortunately, our compliance doesn't have a way to log the chat feature yet. So when we do Q&A here in a moment, we're going to ask that you just simply click on the raise hand feature, which is at the bottom of your screen. And then Corey will call you out and call on you, not call you out. He might call you out. He'll call on you to go ahead and ask your question live. Also, if you want to email in a question, you can email Maddie at falconwealthadvisors.com, and she'll make sure we get them as well. And that's MADDIE at falconwealthadvisors.com. She's tuning in as well right now, and she'll make sure that we get your question answered. For today's topic of the webinar, thank you again for everyone that's tuned in. For today, we wanted to talk about the stock market and the current market pulse on where things have gone and where we think they're headed. But before I get into that, I wanted to talk about our team, Corey, because our structure has changed pretty dramatically, and our team has grown. So I wanted to introduce some of our new team members so that our clients here can get a feel of the way our team is operating. And so I'm just going to share this picture here of our team, and maybe you and I can comment on everybody on our team and the roles that they play so that our clients who are tuning in today can get a better understanding of who to contact if they have questions. All right, good. So again, Corey, it starts over here on the upper left-hand corner with you and I. How long have we worked together now?
12 years.
12 years. Wow. So we've been working together a dozen years. You and I are the two wealth advisors on the team. We used to, and we tried this. I mean, we tried this for, I don't know, 12 years, 10 years.
Several of
we've
those
always
12.
had. We've always had a third or fourth or fifth partner. We've had junior partners, a lot, junior advisors, almost ever since you kind of, maybe after 2 or 3 years of you and I working together, you and I always had a junior advisor working with us to kind of help service a lot of our newer clients. Unfortunately, that hasn't worked, and we've had far too much turnover. You and I really weren't impressed with some of the advice that has been given out. So to avoid that, we have eliminated the junior advisor position on our team. Right, Corey?
You got it.
Thank you.
I'm sorry. Yes, we
So,
have.
so instead, though, what I'm proud to introduce is that we have 4 financial planners on our team, which if you're not in our industry can get rather confusing. So again, the point of this is every single client at Falcon Wealth Advisors, you're part of a group, an elite group that we consider elite, that all of your advice is rolling up directly from myself or Corey. Both of us have attended the investment strategy and portfolio management course at the University of Pennsylvania's Wharton School. Both of us are chartered retirement planning counselors. We give a very collaborative approach on our advice. You and I will talk about Roth IRA, Social Security, Medicare, health insurance, all of those topics you and I always discuss and collaborate on. So all of the clients are rolling up directly to you and I. And then each of us have 2 financial planners that work as extension of us for all of our clients. And Corey, I'll let you elaborate on what those planners do a little bit.
Sure. So the planners that are, really the extensions, Jake, of you and I, like we were just talking about here, a big part of their role is obviously joining us in client meetings, helping with, taking notes and following up, but also Matthew, Joe, Jake Cross, and Alyssa are doing a lot of the preparation work, making observations in clients' financial plans. Anytime we're meeting with clients and we evaluate different scenarios and help folks understand the impact on their plan, it's typically our planners who are doing a lot of that work and setting us up to have that conversation. So while you and I are the advisors, the educated financial planners that are working alongside us, really know the ins and the outs of the planning software, the Roth versus traditional contributions to 401ks, the most efficient and the most optimized and tax efficient way to save, et cetera. So really the whole idea is, Jake, for, at least from my perspective, for you and the 2 planners that you work with, and the same for myself, our clients know that all of us are here for them, can help answer questions. All of us can meet with them, frankly, and help them understand what their financial plan means to them too.
Right. Thank you, Corey. So that's exactly right. And so we are functioning now. We used to function as a solo or silo practice, and now it's called an ensemble. So what that means is that you basically have Joe here and Alyssa are extensions of you and working with you and all of your clients. Joe is actually starting to meet with some of your clients one-on-one. Now, again, he's not a junior advisor, though. He's a CPA, and he's an extension of you. So in order to keep servicing our clients and giving them the custom advice, we need Joe on our team to be able to take some of those one-on-one meetings off of your plate and communicate your message. And the same holds true here with Matthew Tomlin and Jake Cross. They're actually both meeting with clients of mine. And so again, if you're meeting with Matthew or Jake or Joe, I don't want you to think they're now your advisor. You're actually getting more service than you were before. You're getting a planner perspective and the strategy and advice that comes from Corey and I, which is really exciting. I've gotten some great feedback from clients. These are smart young professionals, and they've been doing a really good job with our clients. So again, not juniors. They're working with all of our clients in some capacity, and in some of our client meetings, they're actually taking those meetings on themselves. Obviously, our client operations group continues to be solid. Sam is a partner now. Isn't that exciting, Corey, right? It's very cool. So Sam's made partner on our team. She's the head of operations. She works with Maddie, Abby, and Mari, and they do all of the account opening, transfers, requests, the day-to-day functions for our clients. All of the interaction with Charles Schwab is really what they are there for. They do a great job. We have 2 part-timers, another Abby for nice and confusing measures, and Luke, who do all the scheduling. So all the scheduling goes through our part-timers, but Sam and her group are doing a great job, and we're really excited for what they're doing. We are actually hiring in that group as well. So if anybody out there is watching or listening to this, and you know someone that could work well in our client operations group, please let me know, because we are looking to add members to Sam's team. And then let's not forget Matthew and Abby, another Abby in our research and trading group. And they've been really busy this year rebalancing portfolios, and that's what you and I are going to get into. But basically, Corey, you and I set the rules or the guide rails, and they're going in there and doing all the rebalancing, buying stocks, selling stocks, trading options, buying bonds, selling bonds. So they've really been very important in implementing our investment strategy for our clients. And they're also available to talk to clients about our investment strategy. We have a weekly investment committee meeting that they both attend, obviously. And so they know exactly what's going on in our thesis and everything, in our strategy.
Excellent.
Now, one important piece, because I know, Corey, you still get quite a bit of emails coming through that aren't pertinent to your function on the team. And so do I. And that's okay. It's, again, a part of resetting expectations with our clients. So for all of our clients, if you have any administrative question, that's not advice specific, you simply can email service@falconwealthadvisors.com. And that's going to go to all 10 of these professionals, excluding Corey and I. Right. So basically the whole team is going to see that email, and whoever's responsible for answering that question or following up with you, that's who's going to grab that email and take care of it for you. But again, if you've got a question about a statement or online access, or what are some of the questions you're still getting, Corey, that frankly, the client's just going to be better served and get a quicker response if they go directly to our service group? Or what's some of the common emails you're getting?
Sure. If somebody wants to take a distribution from their account, if their intent is to open a Roth IRA for Roth conversions and they need to open a new account, whatever it might be, those are, just a handful of the items, Jake, like you mentioned, that, ultimately that client will be best served going directly to our team, because they'll be the most prompt and obviously will be the ones to take care of the requests.
Right. And our time is best spent in meetings with clients. And that's really, if you don't hear back from me or Corey during the day, it's probably because we're in a meeting with a client more times than not. And I don't want a client having to wait for something like that. They can get done
exactly
quicker. So again, you're going to be better served. Just go directly to the service group. Everybody on our team is great. They're sharp. They're willing to help you out. If it is advice related though, so let's say, like you mentioned, a distribution, not a big deal. But if you need to take out 200 grand,
sure.
Well, we should probably talk about it for most of our clients, right? So I don't want you to think that you can't still email me or Corey directly for advice. We're saying if it's not advice specific, you should definitely go directly to the service group.
Perfect.
All right, good. So we'll end the team discussion there. Let's go into the market, Corey. So as of year to date, the S&P 500 has plummeted down to 7%. And a lot of our clients are starting to ask questions, rightfully so. Some of them are starting to panic. And most importantly, maybe we should talk about what we think about this current market and what we're doing about it. So why don't you go ahead and give me your thoughts on what do you think about the pullback that we've had here? We're a month and a half in and it's down 7%. What are your thoughts?
While it's never settling when it happens, it is part of being invested in the market. And the last couple of years have, we have been blessed with very strong returns. The market has provided strong returns the last, really 2019, 2020, and 2021. There's been volatility, of course, along the way with the pandemic being a part of it. But to bring it back to 2022, to see the market pull back 7%, 8%, 10%, whatever it might be, historically speaking, that happens more often than it has the last couple of years. So that's one part of it. But we're obviously, in tune with what is causing the decline. If it's concerns about higher interest rates, inflation, more recently, Russia and the Ukraine. And then, of course, there's another election coming in November, which I'm sure everyone is excited for another election cycle. I certainly know that I am not certainly excited about it personally, but it's part of it. But all of that has just created to a level of, from my perspective, just uneasiness and instability that's caused some people, reason for concern.
Yeah, and I just think it's human nature. And like you said, you mentioned, we had 3 years in a row, and 2 of those years during a pandemic where we had way above average returns in the market. And our clients' portfolios, many of them are way over their target expectations, which is awesome. So we get a little pullback here of 7%, and it stings a little bit. But did you know this, Corey? And maybe you did. Did you know on average, the market pulls back 10% every year on average?
Yes, I did.
That's good. And did you know on average, it pulls back 20% every 3 years? You didn't, you knew that?
I did.
And 30% every 5 years. So my point is, negative pullbacks in the market, while painful, have never proven permanent. And so even though we have these 10, 20, 30% drawdowns, the market over time has far appreciated faster and longer then it has declined. And Corey, maybe you can comment on why is that so? Why does that happen? The bounce back or the increase.
Sure. What, at the most fundamental level, what is ultimately driving the value of the market is a few things. And, earnings is a big part of it. Interest rates and dividends, right? Income. And really, earnings and interest rates are probably the two biggest factors in what determine, the direction of the market. And over time, right, as the market has grown and companies have grown, and we've seen the market grow, that is all a byproduct of corporate earnings mostly.
Let's talk about that. Let's talk about that real quick. So corporate earnings, why do we, so this is good to know for clients. What have you and Cassie done more of during COVID than you did before?
Shopped online.
Exactly. Yeah, exactly. Same with Rachel and I. In fact, what's that?
Much more. We've done a lot more of that.
In fact, we did a major home renovation that I'm confident we wouldn't have done if COVID hadn't taken place. So we hired contractors and built out shelves and painted and bought furniture, spent all this money that was earmarked for something else. So that's what we're getting at when you say earnings. So, and it doesn't even need to be earnings need to be good or bad. They just need to be better or worse for the market really to participate. Meaning when COVID broke out, the market crashed. Believe it or not, do you remember this, Corey? It crashed 30% in 1 month.
Yep.
In 2020. 30% 1 month. Right?
Which was the most significant 1 month decline ever.
Right. And what happened? Well, 3 to 6 months later, it was already reaching new highs.
Right.
Crazy. And again, it's because the world didn't end. People kept shopping, kept buying things, and the market stayed resilient. So you're right. Today, the reason that we feel the market is down, inflation concerns are built in. There's uncertainties about the Fed. Earnings are kind of up in the air because of what Omicron and Ukraine and Russia, what's going on over there. We got the midterm election. And don't forget taxes. Taxes are supposed to go up. What happened to that? That used to be on every webinar that I would see, the new tax bill, the new tax bill. We don't even hear about it anymore.
Yeah, it's interesting. You mentioned at the beginning of our call, Jake, that you and I started working together 12 years ago. And in those 12 years that we've been working together, higher taxes and higher interest rates have been all but guaranteed, right? All along the way. And that's obviously not what we've seen happen. But my point is, even when we evaluate where we're at now, and the circumstances are always different for what causes a decline or, how the market's going to react in the future, particularly as it comes to rising interest rates. I mean, I've been pretty much all 12 years that you and I have worked together, Jake, I have read and heard that interest rates have nowhere to go but up. And they've done the exact opposite.
Right. So that's another good point, that if you're listening to some guru or somebody that claims that they know what they're talking about, predicting interest rates, they don't know. So let's go into that segue, and then I want to open it up for some questions. So what have we done? So I want to talk about things that we've done and shifts that we've made in the portfolio. First and foremost, everybody that's in tune with the market or the economy knows that inflation is here, right? That's not a surprise anymore. So I don't want people to be alarmed if they hear CNBC or somebody talking about inflation. We all know it's here, right? It's here, it's happening. We're all experiencing it in some form or fashion. So what we did, though, was at the beginning of the year, we rotated our portfolio into certain sectors or individual stocks that we felt would stand to perform better during an inflationary cycle. And that was all intentional and purpose, right? So those are some obvious things. And again, this is why we don't outsource to index funds or mutual funds or annuities, because yeah, they may be doing that, but they also may not be, and we don't have any control. So it's very easy for you and I to turn that dial and say, you know what, inflation's here, it's present. Let's get out of some of these stocks that we think have overrun. Let's get into some where we see some opportunity. And more importantly, hopefully they'll be better during signs of inflation. And so that, to me, was a very obvious move. But we're not trying to time the market. We're not going to get all in. We're not going to get all out. For I don't know what it is. It must be 98, 99% of our clients, anything they have in stocks is capital that they don't need to touch for more than 5 years. So frankly, even though the market's negative out of the gate here, it doesn't really matter to most all of our clients. really the reason you have stocks is so that you can get that long-term capital appreciation and grow your portfolio faster than inflation. That's really why you own stocks. And that's why we own stocks, and that's why we're managing it accordingly. Maybe we'll pause there, Corey, unless you wanted to add anything. We can open it up for some questions.
Nope, I think that is, I think that's good. I just wanted to add real quick, because I read this in a report this morning, that for 2021, for the fourth quarter, those are the earnings that companies have been reporting here in 2022. So 72% of companies have reported their earnings for 2021 Q4, and earnings growth came in 31% higher year over year relative to Q4 of 2020, which again, when we take a step back and just zoom out and look at the big picture, that is a big contributor to the bounce or the recovery that we've seen in the market since the pandemic started, is that earnings and profits recovered a lot quicker than people anticipated.
Right. And that's a part of the reason that we've seen this growth. Now,
Yep.
So again, I don't want you to be concerned about seeing your stocks down. It's part of it. We're monitoring it. We're watching it. We're making trades. It's part of the cycle, though. So let's open it up. So because again, I want to talk. This webinar is really for our clients and our potential new clients. Let's open it up. And if you want to just hit that raise hand function, I'll do mine here, right? Raise hand function, and that'll let Corey open up your mic so that you can ask a question. All right, good. While people are formulating their questions, Corey, let's talk about the bonds then, because that's been another somewhat of a head scratcher for some of our clients. And so with bonds, it's very important to understand with bonds that their pricing has a directly inverse correlation with rates. So if you see interest rates going up, which they are, right, and they're going to continue, that therefore, by definition, bond prices will fall. Ultimately, though, again, that doesn't matter for our clients with their bonds in many situations for two reasons. And the first reason is typically the interest rate is going to keep paying regardless of the price. So if you have a bond that yesterday was worth $100 and today it's worth 95, if it's still going to pay you $100 a year, whatever it is, 50 bucks a year, whatever that number is, that's going to keep coming in regardless of what the value does. So I don't want clients to be concerned if they see bonds down either, because they're paying out interest. Another thing that we've done though in our bond portfolio is that we've started buying very short-term maturing bonds so that when interest rates do go up, we will have a lot of cash coming available for our clients that we can turn around and buy in new bonds that is paying hopefully much higher interest than we're getting today. So the bond portfolio is a whole nother dynamic and something else that you and I are managing and our team and our traders. But that's, so I don't want you to be alarmed if you see your bond portfolio down as well. We know that's going to happen. And when those bonds mature, we're going to buy new bonds paying higher interest, which we're actually really excited about. So it's going to be a net positive as long as we keep that bond portfolio intact.
So that brings up a good question though. I mean, Jake, I'm sure for clients that are, at home or at work watching and listening to this. So when you talk about bonds maturing and ultimately getting the principal back that can then be reinvested, how often do bonds mature?
Good question. So bonds mature, they all have a different maturity date, right? So you can buy a bond that matures in 3 months. You can buy a bond that matures in 30 years. You can actually even have a preferred stock that its payment is perpetual, meaning it just keeps paying you that dividend or interest. So what we do is we ladder those maturities out, basically staggering them. Used to be 1 through 10 years, but now we've really shrunk that down, Corey, and we're looking in that 1 to 5 year range or even sooner, because again, we want to anticipate interest rates going up and we want to have more cash available to lock in interest rates once they're higher. So we can adjust that maturity length when we're buying bonds and choose exactly when that happens. So historically, we've gone 1 to 10. Now we've shortened that. Some of our preferred stocks are perpetual, meaning they're just going to keep paying interest regardless if rates go up or down. And that's okay. And that's why they're in there. But a good portion of them we're going to be looking to hopefully mature here soon.
Okay, good.
Did I see a question roll through the chat? Maybe we can read it out loud.
Yes, you did. So here's the question. Did you talk about the dollar cost averaging and its advantages with the volatility we are experiencing for those of us that are still working?
Yes, thank you. Thank you for that question. So what this question is referring to is dollar cost averaging is a basically systematic way of investing where you put the same dollar amount roughly in over a defined period of time. So the English version of that is, Corey, every 2 weeks when you get paid, a piece of your paycheck goes into your 401k, right? That's the English version. Now, if you're an active corporate employee or employee and that's how you get compensated and that's how you're able to contribute to your retirement plan, that's a good thing. However, historically speaking, if you think the market's going to go up over time, dollar cost averaging actually hurts you more than it helps you. And the reason is you have to, if you're buying and the market goes up more than it goes down, then if you wait to buy, that means every time you buy over time, you're actually paying more for whatever stock or mutual fund, whatever your investment is. So my preferred method is to lump sum invest. So if you have the cash available, I would much rather see a client invest it versus dollar cost averaging. But dollar cost averaging is not horrible. It works during temporary pullbacks like we're seeing today. But if you chart it out, dollar cost averaging actually hurts somebody more than it helps them.
Right. But if someone is working and the way that they are saving money for retirement is through their payroll deductions into their retirement plan, that is the right thing to be doing as far as saving goes, right? I mean, assuming that you don't already have your career earnings sitting in a bank account that you can go and dump into the market. Yes. But I always talk with clients too, that while you're still working and still making contributions, that, the value of any given investment in the 401k plan on any given day is really less important than the number of shares that you own, right? Because if the market is declining, you're buying more shares, but the value of those shares isn't going to really matter until ultimately retirement or closer to retirement. So if you're actively making contributions and buying shares in your 401k plan, market decline gives you an opportunity to buy more.
Right. And another way to think, thank you. Another way to think of that is if you're retired, right? So the retiree, we recommend they take out money as they need it, right? So that's dollar cost averaging working in their favor because we believe the market's going to go up over time. So we'd much rather than pull money out, sell over dollar cost averaging versus pulling out, let's say you need 100,000 a year from your account. Well, we don't tell our clients to pull out 100,000 on January 1. We want that money in the market growing. Sometimes it goes down, right? But more times than not, it goes up. So,
and depending upon how that money is invested, it can be generating income.
Right. So believe it or not, I'm not a fan of dollar cost averaging unless that's your only option. I am a fan of saving.
Good.
Thank you for that question. And yes, so if you do have a question and you want to ask, just simply raise their hand function here at the bottom, and Corey and I are happy to answer it live. So is there any questions out there? Do we have any fears about the market? Curious about, what's going to happen in the next 2-3 months, next 2-3 years? I feel like we've answered a lot of that, Corey, but again, this webinar is for our clients. We want to make sure that they feel confident and comfortable with everything that's going on. Here we go.
All right, Keith, you're up.
Sure. So again, I'm probably one of your younger clients, but so again, when we are calculating the amount that I need to retire, are we factoring in inflation, and at what rate of inflation are we factoring it in? So again, if I need, let's say, $5 million to retire, is that 5 million in today's dollars? Is that 5 million in dollars when I'm 60?
Thank you, Keith. Thank you for that question. So yes, we do factor in inflation. Historically speaking, and this is a little bit higher than the Fed's target, I believe, Corey, you can correct me if I'm wrong, but we factor in a 2.53% inflation rate. And we factor in your spending going up by the rate of inflation. So if you have 5 million as the goal when you go to retirement, your spending goal will be adjusted for inflation to reflect if that 5 million is going to be sufficient. Now, there's two really neat things about our financial planning software that Keith, we're happy to go over with you and any client. We can toggle that inflation number up, higher or lower, but you have to be careful with that because two other things on that. I'm going into a little bit of tangent here, but if you toggle inflation up, when you do it in the program, it's also going to assume you get higher Social Security cost of living adjustments, which you would if you had higher inflation. And typically stocks by their nature are inflationary. So those would be going up higher than our target rate of return. So you got to take that with a grain of salt. Another neat thing though that our program can do is we can back out and show you. So if we're going to show you having $10 million when you're 90, we can show you what that is in today's terms and back out inflation. So not only do we factor it in, we can also back it out.
On that same subject, I'd like to just add a little bit further to that as far as inflation goes. Because we've all seen the headlines. We know the numbers, that were released last week that, year over year inflation had climbed by 7.5%, which is a significant number. It was the highest in 40 years.
40?
40 since 1982. So there's no question that 7.5% is higher than 2.5%, like we talked about, Jake, but also, over the last decade, there's also the same way that we don't make the assumption that, if someone has a great year in the market and their account makes 15 or 20%, we don't assume that's going to persist in perpetuity. The same thing goes with inflation. And I do think because I actually just recorded an episode of my podcast about this, and because I was just doing some research on it, like literally this past weekend, that if you look at the inflation numbers year over year, the areas where there have been inflation and the areas where there has not been inflation, and used cars are up 40% year over year, and gasoline is up 40% year over year. And interestingly, healthcare, prescription drugs, higher education.
Wait. Hold, let me interrupt you.
Yep.
Used cars are up 40% year over year. We got to talk about that.
They are.
So I could sell my car right now and make 40% more than I would have last year.
Possibly, but then you may have to buy another car for 40% of a higher price.
Why?
You would have
Why? You live right by me.
Well, I guess I could drive you around.
I can sell my car for $2,000 less than I bought it for.
And what year is it?
It's a 2020.
That's crazy.
Cassie and I traded in my wife's Jeep. Cassie bought a Jeep. It was a 2017 that she bought at the end of 2017 or early 2018. Drove it for several years, and we traded it in last year for almost the same price that she paid for it years before.
All right, so I had to interrupt you there. So that is an opportunity, though, that if you, I don't know, I think there's an opportunity there just from a financial planning perspective. But go ahead. What else were you saying?
Really, what I was getting at is where there has been inflation and where there hasn't been inflation. The areas where we have actually seen inflation the last several years, healthcare, higher education, prescription drugs, et cetera, those have hardly moved from a year prior. But gasoline, vehicles, actually airfare was part of that. Hotel rooms, this is a national number, but hotel rooms, it's like 22% higher than a year prior was the cost. My point is, while I acknowledge and frankly expect that inflation will be with us for a period of time, I can't look at those numbers objectively and say that supply chain challenges and everything shortages, but microchips being part of that for vehicles. I can't look at those numbers objectively and just assume that this is the new normal. My point being, I do expect inflation to move higher, but when we see that 7.5% year over year number, we have to understand what's contributing to that 7% and then understand what are the factors at play causing that. And used vehicles is a perfect example of, I don't expect that to grow 40% year over year, each and every year moving forward. So some of the inflation, what I'm really getting at is still, some of it is temporary and some of it is due to the economic global shutdown because of the pandemic and the timeline that it's taken to get things back online. So I think if nothing else changed over the course of this year, the Federal Reserve didn't alter their policy at all, my expectation is that we would still see inflation cool off some, simply as more time passes and more things normalize.
Right. Time will tell. Corey, I think we had our compliance is going to get mad. We've got another chat in here, but go ahead and read it out here for me, if you don't mind.
All right.
I thought can we disable this chat function?
I'm sure we probably can. Let me read this question and then we can take a look at it.
All right.
And thank you, Todd, for the comment that my photo looked like myself from high school. All right. So the question was, if you're unsure if you will make too much in income to invest fully in a Roth for 2022, do you suggest investing now and recharacterizing / moving later if necessary, or wait until the end of the year to invest if it is feasible? Good question.
Yeah, thank you for that question. So going back into my lump sum investing, right? If you adhere to that theory, the answer would be sooner would be smarter because you get more time in the market versus dollar cost averaging in. However, with this type of situation, a recharacterization can be messy and complicated. What I've typically done is you have until April 15th the following year to contribute to the prior years. And so you could wait to make sure that everything is settled. That way you can get it in there still. I think you're splitting hairs a little bit. As long as you're putting it in every year, I think is the most important thing. But I don't know, Corey, maybe you disagree, but I would wait to make sure that you're going to be eligible, because you're going to have to calculate interest and earn. If you invested in a Roth and then you have to pull it back out, you may have to calculate earnings and interest, and you could get audited. Then you're going to have to pay for a CPA to help you figure it out. I mean, does anybody want to deal with the IRS more than you have to? Like, I don't. So I don't think it's worth the hassle, but maybe you disagree.
No, I do agree with that. And if it were me and I was in the exact same situation, I would wait until the first quarter of 2023 to determine if I can make 2022 Roth contributions, because the recharacterization can be messier and stickier and more of an issue to deal with that could be avoided by waiting.
Yeah.
So if you're on the cusp of not being sure whether or not your income will be too much to prevent you from making Roth contributions, you can wait until the first quarter of next year. And if your income allows you to make the contribution then, you can make the 2022 contribution then.
Now, one thing I wouldn't wait on, and you're welcome, one thing I wouldn't wait on is the backdoor Roth. And Matthew Tomlin, one of the planners on our team, and I disagree on this, but there's hints that they may take away the backdoor Roth contribution. Basically, what that is, if you make too much money and you don't have an IRA, is the easiest way to do this. If you don't have an IRA and you make more than you can legally put in a Roth IRA, you can actually put after-tax money in an IRA and then turn around and convert that to a Roth. Now, they're talking about doing away with this because by its definition, the backdoor, it's kind of a loophole out there. But I would argue to go ahead and do it if you qualify, because I would think if they change the rule, it might be like, hey, as of May 1st, you can no longer do this, and you might be scrambling to try to do it. So I would argue if you want to do that, to take a look at it and talk to us about it. Another quick point on that tax planning question, though, that many of our clients may or may not be aware of, but Corey, you and I have invested in some pretty heavy. And if we could please get the questions, can we turn that chat off? Because compliance isn't going to be okay with this. If we could please, oh, sorry. So we got into this tax planning software, Corey, that you and I bought. And what's really neat is after you file your returns, we can take your tax return, scan it into our software, and give you some tax planning observations to look at Roth versus non-Roth and, Medicare, lowering your taxes basically is what we'd be doing. Now, we're not looking to replace your CPA, but we are looking at enhancing your basically tax planning offering. So that's available to all of our clients. All you need to do is upload your tax return onto the Vault and let us know. That's through your eMoney login for your financial plan. And again, like I mentioned earlier, if you have questions on that, you can simply email service@falconwealthadvisors.com. Our planning group heads up that strategy. And please forgive me, our compliance doesn't let us use the chat because they don't have the technology to appropriately archive it. So we will need you to raise your hand and ask questions live, like Keith did. Corey, was there another question in there?
Yeah, there was, and I will speak to that. The question was around going back to the backdoor Roth contributions. What if you already have an IRA? And that's where the pro rata rule comes into play. So if you have an IRA that is funded, your ability to make non-deductible IRA contributions and convert them to Roth, you need to be mindful of the pro rata rule. So it may prevent you from being able to do that, or at least for it to make a whole lot of sense to do it from a tax standpoint. But ultimately, that's something that's going to come down to an individual basis. And I would recommend, we can follow up further on this if you'd like to talk about it, for yourself individually.
Right, right. Thank you for that question. But yes, exactly. So if you have an IRA, it doesn't usually make sense unless you've got a really small one. If you've got a big IRA and you put money in a Roth, it's basically turning into a Roth conversion, which is not a bad strategy. But again, we need to look at your tax return to really give you advice. That's what we want to look at. And that's what our financial planners would do. And again, you simply email service@falconwealthadvisors.com and they can assist you with that.
Perfect.
Good. These have been really good questions. Any other questions before Corey and I get back at it today? Well, thank you all so much for tuning in. We're going to continue doing these webinars. Corey, do you have any other closing remarks here?
No, actually, yes, I do. The quick closing remark I would make is if you are retired, recently retired, approaching retirement, and there are questions or concerns that you have around what we've seen happen in the market thus far in 2022, just remember that's exactly what Jake, you and I and our team are here for, is to help our clients understand what their plans mean to them. So frankly, from my perspective, we're not doing our job if someone is losing sleep at night about one thing or another and we're not having a conversation about it. So please make sure if you have questions or concerns or want to talk through things further, that is why we're here and that is why we have a job. So we're happy to have those conversations, and please don't hesitate to reach out to us.
Yeah, thank you, Corey. You're exactly right. And again, understand that normal market pullbacks are just that, they're normal. We've seen it. We've seen 10, 20, 30%. We had 30% pullback 2 years ago. And so that to us is an advantage of owning individual stocks. We have control, transparency, and that's very important. We're rebalancing, we're making smart decisions. And like Corey just said, we don't want anybody freaking out or being nervous, right? Call us, email us, let's set up a call, let's set up a meeting. It's another quick point. Our offices are open. If you want to come down and meet in person, we'd love to see you. So we are meeting clients in person. We're still doing Zoom. We're still doing phone reviews as well. It's all open and all available to you. You just have to go through our scheduling link and you can pick whichever method works best for you to meet. Thank you so much. Hope everyone out there is staying safe and healthy. We'll keep doing this. Thank you, Jay. And thank you all for tuning in, and I hope you have a great week.
Thank you.
Thank you.